What's going on, everyday people and the degenerates of Wall Street bets? You're watching Math Head. This is going to be a super detailed video, and I'm going to need some coffee. I normally don't drink coffee, but I'm taking a big one for today's topic. All right, so this is about the GameStop short squeeze, GME. I mean, you should have heard about it by now, and it looks like it's running up again. I haven't checked all the numbers on the options and the stock side to see if it actually is like a short squeeze or a gamma squeeze or whatever's going on. Any of the crazy crazy names you want to call it. But basically, in this video, I wanted to outline, because this is a perfect example, because I've been talking about investing and how you can model your investment portfolio on MathHead and how math plays a role in that, because MathHead's channel is all about how math works in everyday life. And this is just a perfect example, so I have to comment on it. I need another sip of coffee. All right, so in order to kind of understand what's going on with the GameStop thing, AMC, Wall Street bets on Reddit, and any of that stuff that you've heard from countless people, you have to understand how stocks are priced, what makes the price, how they're sold short or short selling, how that happens, what options have to play, what role options have to play in it, and the different players of the game, basically, as well as the mathematical models behind it that are used in algo trading or algorithmic trading. So, like I said before, and now you know, like the need for coffee. So grab yourself some coffee and let's get started. So, first off, when you buy and sell a stock, you might go to some website like Robinhood or some other trading app, E-Trade, Fidelity, whatever, and you go look at a stock's quote, and you see, okay, it's going to be this amount of money. I want to place some kind of bid for that or an ask price, and I want to either buy or sell this stock. Now, you need to have margin to short sell a stock, but we'll get to that. So buying and selling stocks is literally just that. You look at it, you have to go through a broker. You look at the price, you have to go through the broker then goes to the stock exchange. Since we're only going to focus on GameStop in this one, that's the NYSE, so the New York Stock Exchange. And then the broker buys from pretty much what's called a market maker. And if you thought it was just a simple buy and sell between investors, and they call them retail investors, you and I, pretty much, who want to buy and sell stocks. If you thought it was that simple, well, you are in for a surprise. And I didn't know how intricate this stuff was until I researched into it initially when the GameStop thing started, and I was like, how is this happening? What's going on? Who would be crazy enough to buy all these stocks as high and everything like that? And so I researched into this stuff and was like just amazed by the amount of information and intricacies involved in buying and selling stocks, and it's just crazy. And it's no wonder the average person gets screwed. So this is gonna have a lot of my opinion in it too, just because it's one of those videos. So if you're here for the hardcore math of stuff, I'll put that in another video, but that includes the options pricing models. So what's normally used is called the Black-Scholes model. You can also use different models to price options, but I would say that is the most widely used. Without looking at someone's algorithm and seeing what they implement, that's probably the one that I would say they use. That's speculation though. So anyways, getting off track a little bit. So you buy and sell stocks. You don't just do that. You buy through your broker. The broker goes and buys through a market maker. And the market maker is the one who sets the price. They set the price to sell at and to buy at. So they literally make a tiny bit of money, sometimes more, but like just pennies and stuff on the difference between the amount of money that you want to buy it for if they're willing to sell it at that price, and the amount of money that the share is actually worth. Okay, so it's like a little bit. So it's like, say the price of GameStop was $5, the quote price, that was the last price that it sold at. Well, if you want to buy the stock, it's going to be like $4.05 or whatever the market maker has set the price at. So that way when you go to your brokerage and then you pay the commission to the brokerage, then you pay the spread is what it's called between the bid and ask. You're asking to buy it at that price. The bid is what you're going to pay. The bid ask price. Well, you're going to pay one of those. So you're paying the difference. And then when someone wants to sell, the market makers set the price a little bit, they set it a little bit lower than it actually is. So then they profit on the sell. They profit on the buy and they profit on the sell. Now, that's how a stock price moves up and down. Because if it was as simple as, I want to sell my stock, you want to buy it, I could just say, I've got 50 stocks, I need 50 people if I want to sell them all. And you come along and you're like, okay, I want to buy a stock from you. So I say, okay, $10. But I sold you a stock for $10. Now other people are going to come and see that and say, okay, well, can I buy a stock for $10? And if I don't see a demand for it, well, I'll probably keep it at $10 or maybe I'll sell it a little bit lower. I'm basically the market maker in that situation. It's as easy as transactions between people. So, but the stock market is convoluted, extremely rigged against the little guy. So it's not as easy as that. You can't just buy and sell from each other. The market makers are the ones who set the price. And the GameStop stock situation is so interesting because it is so involved in all of this stuff. Now, there's a market maker, and it's not like, oh, the market maker is like it's a conspiracy theory term. It's an actual thing. So you can go online and look up market makers and see who they are. But the big player, one of the big ones in this is Citadel. So the New York Stock Exchange is the exchange which houses or indexes GameStop's stocks. So that's the exchange you go to when you buy and sell, or your brokerage you go through. A lot of people were using Robinhood to buy GameStop. And on Wall Street Bets, on the Reddit forum, and I'll post a link to all this stuff in the description below, they were talking about, hey, well, Robinhood, they're supposed to be this awesome, free fee, no fees or whatever, you just come and trade and this and that, and you'll be good. And this is another reason why day trading and all the algo trading that doesn't really think about long term might be so just way too risky and make people lose money. And that's why I don't really like recommending trading in general unless you have money to throw away. If you have money to just, like, you were gonna buy shoes or whatever, a couple $100s a month that you don't want, you would use for expenses like entertainment stuff. Okay, put that in the stock market or something. Like, unless you know what you're doing and you know all this stuff, which still doesn't eliminate uncertainty, risk, and craziness, like Robinhood stopping the purchasing on all the call options and all the stocks, and then you can lose all your money. So to continue on with this craziness, GameStop was starting to increase, and this guy, DFV, deep fucking value, he was a purchaser of call options, and he was posting his things on Wall Street Bets, his screenshots and stuff, like, hey, look at this, I've made 50 grand or whatever by holding these call options that are, long time expiration and out of the money, basically. And okay, so I don't want to get too ahead of myself. So the stock market, that's how it is. You buy the money, the market makers set the prices, okay? So now you have to understand the options, at least a small extent of the options. You don't have to understand those Black-Scholes model for the options pricing. mentioned earlier, 100%, but you do have to understand they normally refer to them as the Greeks, but the risks that they're measuring, as well as the fact that those options models and different financial models incorrectly assume normal distributions on things in financial markets when they might be, as other people like Nassim Taleb has referred as, fat-tailed distributions, or distributions where crazy events like 5 or 6 or 7 sigma or whatever are actually more likely to occur than they should, as predicted by a normal distribution. I know a lot of this stuff is going way over people's heads, so it's difficult to try to convey this and keep it as simple as possible. But basically, you just have to know that the Black-Scholes model is flawed when it comes to predicting risk and what you should price an option at. And in this instance, the GameStop instance, the call option, when you are extremely out of the money. Okay, let me first define those terms. So, in options lingo, at the money is when the price of the option is the same price as the underlying asset that you're taking the option on. So the stock. So if GameStop was $10 and the option was $10, you're at the money. Now, the stock price can fall and say it goes to $5. Now you're out of the money, $5. You paid $10 for the option to buy the stock at $10. That's what an option is. It gives you the ability to buy this underlying asset at that price. And generally it's very leveraged. So if you're going to buy one option for $10 on a $10 stock, for example, you will say that, okay, you're going to pay that price of $10 to buy 100 shares of GameStop at $10 a share. So you'd be paying $1,010 for, 100 shares. You don't have to exercise or cash in that option and buy those shares as long as the expiration date is pushed really far. So that dude, Roaring Kitty, also on YouTube, known as Roaring Kitty, aka Deep Fucking Value, was buying call options that were far time expiration, and they were, I don't know the exact price, but if they were out of the money, then they were probably very cheap, because the Black-Scholes pricing model to price the options, it prices them extremely low out of the money call options, extremely low compared to what they could be if you used a fat tail distribution or a different distribution than normal distribution, because the probability of you making money on that is extremely low. But the interesting thing is when you go on Reddit or you go somewhere where you have a huge influence like YouTube, and you push out, hey, I'm making money on this, I bought this, you should buy call options. And then there's other people like Michael Burry and Mark Cuban and other people who are like, hey, yeah, buy call options and hold, this will happen, out of the money call options. That means you can get in there lower than you should be able to because of that mispricing of the options based on the Black-Scholes math model. So, I need another sip of coffee. So basically, when you get a bunch of people congregated together buying call options, that's leveraging. Like I said, one option generally refers to 100 stocks underneath that. So market makers, they have to buy options and they buy stocks, and they are there to facilitate the liquidity or to make something easy to buy and sell. Because it's not like there's going to be people all the time who are like, oh yeah, I need to buy and sell this stock or this option for a lot of different stocks. It could be like 10 people want to buy and 100 want to sell. Well, the 100 people who want to sell are going to sell to the market makers. They're going to make the difference between what the people want to sell at and what they listed at and to buy it. and then there's going to be a couple buyers, and the market makers will sell to them, but a little higher. So they're making money up and down. What's interesting about this GameStop fiasco is that Citadel is a giant market maker, and they buy options and they buy stocks. They were also invested in they also have a hedge fund actually that invests in different companies, and so they were invested in Melvin Capital, which is one of the big institutional investors that is having huge trouble right now. They lost a ton of money from this GameStop thing, and they were invested in them, and therefore were invested short in GameStop. Now, short selling is the process of borrowing shares basically from someone else and selling them at the current market price because you think the price is going to go down. And then you can buy the shares back and give them back to the person that loaned you them. Well, Citadel is the market maker. So if you short something and you sell it to Citadel, well, they'll sell it lower, and it drives the price lower and drives the price lower and lower and lower every single time you do this. And so that could keep the price possibly, really low. With GameStop, there were short positions over 100%, and that is generally known as naked shorting. And some people have tried to say that, oh, well, it's because you short from one person and that person shorts it, and there's a chain of shorts and stuff, but that doesn't make sense. And the governing boards and the people who institute these short selling positions, they should definitely realize, like, okay, this was 100% shorted, you can't short anymore. But somehow, boom, you short it, they want to call it a naked short or not a naked short, whatever, it's 140% shorted, which means that there's 140% of that stock that was shorted by these people and in a position to do a short squeeze on, which means that if you had a whole bunch of people rush and just buy the regular stock at the stock price, it would shoot up the stock because the market makers buy it at a higher and higher price, and then eventually you could sell it at a higher price, the market makers will buy it, and the investors who purchase the short sales have to cover their losses, or else they have to go bankrupt, or and if they go bust, the broker who lent them all that stock, they have to front the bill. So it's going to be left with someone holding the bag or someone without a chair, if you're thinking of this like that. And it's super, super involved. So you have that. You have Citadel as the market maker on the New York Stock Exchange while all this is happening. Basically, they took over the market making thing on like October 2020, I believe, or somewhere around there. And before that, you had them invested in the Melvin Capital, and they were shorting GME. So Citadel seems like a very prominent player in this. Additionally, you have Robinhood that trades with no fees. You don't have to pay fees. You can just trade. It's amazing. Fees eat up your money. You don't want fees. They're bad. And when I first heard of Robinhood, I was like, how the hell can they do that? And I was just like, I didn't find out until all this stuff started unfolding. And it came out that Robinhood was selling information to Citadel about the buys and the sells. So as market makers, if you have information like that, you can set the price however you want because you have volume, you have volume data before it's and in computer algorithm terms, like milliseconds, just tiny amounts of time are so important to making money because you can know the information, the person places a bet, someone wants to buy in a stock price, you have that information a few milliseconds before they place it, the price, you can jack it up because you know that the demand is high or something. But on the other hand, market makers want to hedge their positions in shorts or in options by buying the reverse. So for example, if someone buys a call option from a market maker, they will sell that call option, but they will also purchase stock to cover that call option, a certain amount. So by doing that, you can see that if you buy a call option, it drives the price of the stock up. If you buy a significant amount of call options, if you buy out of the money call options that are low priced because the Black-Scholes model is inaccurate when it comes to these kinds of situations, then you get this crazy market maker purchase of shares going up and up and up, in addition to a short squeeze where the money is coming in from people just buying the stock regularly because it's going up and up and up from Wall Street bets, and you get this crazy thing known as the GameStop short squeeze, gamma squeeze. And I thought it was so fascinating. Like, the dynamics were crazy. A lot of people lost a ton of money, and a lot of people gained a ton of money. And for you guys who made a ton of money, who the little guys, you know, that's awesome. That's cool. The big guys who manipulate the markets and all of that stuff, that's just like, I have no feelings for them at all. I don't care about them at all. You know, like, you're gonna manipulate the markets, and you know that people are uneducated, but at the same time, don't be uneducated and learn your mathematics. And that's another reason you should subscribe to MathHead. So yeah, this has been a really long and intellectual, deep video, and this is only the surface, you know, the mathematics lying behind this stuff. And I'm going to do a Black-Scholes formula explanation video coming up, you know, not anytime soon because it's a very involved formula, and to break it down to a more general audience to be able to have the math be appreciated or see how it can be abused, it's going to take a lot of time. And I'm a busy guy. I run a lot of companies, so subscribe to the channel if you like this video. Give me a thumbs up, and post a comment below. Let me know what you think. Are you part of Wall Street bets? Did you YOLO some money? Let's chat about this. It's exciting times what we're living in. All right, take care.